Welcome to the Papertrail, where we follow the journey, my journey, through the world of a CEO of a mortgage note fund. I'm Chris 70, and after years of buying, managing, and selling notes with 70 investments, I'm here to share the real stories behind the deals. What went right, what went wrong, and what I wish I knew earlier. From non-performing loans to seller financing to private lending, this show is about more than strategies, about growing your business, learning to follow the paper trail, and doing the due diligence that separates the pros from the rest. Now, let's hit the trail running. Welcome back to the Papertrail podcast. Today, I want to talk about which capital raising strategy actually fits your deal. So whether you're a note investor looking to start your first fund or other types of real estate investors, and you're launching that fund, raising for a startup, scaling your portfolio, knowing the rules can not only save you time, but money, and most importantly, a ton of headaches. So let's first start with the four main options with some pros and cons of ways to raise money. First, we'll talk about a Regulation D 506B, as in boy, offering. Now, this is a private round investment, and what I mean by that is you cannot advertise. The SEC, this is an exemption, doesn't allow you to advertise. It's open to accredited investors, which are people who either have a net worth of $1 million outside of their primary residence, have made over $200,000 a year, or combined $300,000 and over the last few years, and continue to look at that. Now, you also can include what they define as 35 sophisticated investors with the accredited investors. Now, these can be non-accredited, but you have to still vet them. So as part of this, when you rule that you can do, again, you cannot advertise. It's usually the most cost-effective way to set up a fund or entity, and we'll talk about that later. The second that we'll briefly talk about is what's Regulation D 506C. Now, in a 506C, some people nickname this the megaphone round. Why? Because you can advertise publicly anywhere. But, and here's the big but, every investor must be accredited, and you're required to also verify that. So it's your responsibility to verify the investor is accredited. So you got 506B, which is no advertisement, accredited, and 35 sophisticated. 506C can blast it out, but everyone's got to be accredited. Third, and this is what we have done, is the Regulation A+ offering, which we'll nickname the retail round, which is like a mini IPO. Now, with Regulation A+ offering, you can raise up to $75 million per year, and it's open to anybody. So retail, as long as you're over 18, you can invest. Now, there's limits if you're not accredited on what you can invest. And then you can, of course, have the accredited. I will say it is expensive. It's time consuming. It requires an SEC qualification. And you also need audited financials. Lastly, there's Regulation CF, which is the crowdfunding round. Some people call us community round. Ideal for local projects, startups. You can raise up to $5 million through an online portal. It's open to everyone, but comes with limits and a lot of platform fees. I view Reg CF not as much as a real estate avenue, but more for tech startups. But we still see some real estate people doing that Reg CF offering. So I've tried to highlight quick snapshot of the four types of offering. Again, you got Reg 506B, 506C, Reg A, Reg CF. Now let's break these down into some categories on how much you can raise, advertising, who can invest, the speed on which it can get qualified, and of course the cost. So I'm going to go probably simplest to most challenging. 506B, you have unlimited funds. You cannot advertise, again, and I apologize if I'm repeating this, but people, again, really need to get an understanding to see what fits within their profile. So that 506B, unlimited raise, no ads, accredited and 35 non-accredited, super fast, meaning you could have your PPM and documents up and running in 2 to 4 weeks, and it's low cost. We'll talk cost later, but consider a 506B 10 to 15,000 to get going. 506C, unlimited like the B. You can advertise, so that's a difference with the B. Accredited only, slightly different than the B, but speed and cost are the same. Whether you're putting a 506B or 506C together, every attorney that I've done, and I have done a B and a C as well, the B is a little bit more documentation, but they're consider them on equal footing. Now let's talk about Regulation A+. Again, it's limited to $75 million per year, which for most real estate investors, not a problem because that's investor money. So if you're doing a $75 or $100 million multifamily project, you're probably going to get 60 or 50 million in financing and raise 50 or 40 million. You still match. You can advertise like a 506C. The difference again is anybody can invest. So retail investors can invest, and you'll typically see the Regulation A offerings have lower minimums. We'll talk about that a little later. The speed it's very slow. It can take 3 to 6 months to get qualified by the SEC, which the B and the C, you just submit Form D with the SEC, which is you file it that day and you're good. Regulation A, the SEC actually reviews it and provides comments and feedback. Again, it's like a mini IPO. Cost, high. You're going to spend 6 figures getting it qualified. And Reg CF, again, it's limited to that 5 million, and this is why you don't see a lot of it in real estate. Yeah, you can do the ads. Anyone can invest. It's not as slow as a Reg A, but it's not as fast as a Reg D, 506B or C. And the cost is medium, in that medium level. So if you're going to go real estate, I would tell you, cut out the Reg CF, but we'll still talk about it, give you the information. But for most people, it's really not that fit. So the takeaway from this, the faster and cheaper you want your raise, the fewer bells and whistles you do get. The more inclusive and retail friendly you want it, the more blue ocean strategy of people you want to be able to invest, the more time, cost, and compliance, unfortunately, you're going to face. Now let's dive into costs. Okay. For a 506B and a 506C, your attorney will create an entity. So there's probably an operating agreement, LLC documents. There should be what's called a private placement memorandum, which is 30 to 50 page document outlining what's your investment, what are you investing in. So call it the prospectus on a public company is what it would be considered. And then what's called a subscription agreement, which is the actual contract that says I'm investing $100,000. Here's all the rules. So many important things to review in that. And one of the things I always recommend, have your attorney review that. Your attorney should review any contract you're signing. If you're signing a $100,000 contract to invest, let them review, because do you know what rights you have in regards to documentation? If there's a conflict, can you sue? Is it arbitration? Is it a class action? Can you not do a class action? There's so many finite details in there. And you also want to understand the ownership structure in regards to, are you investing in an entity that's investing in the fund and that entity basically goes belly up, you could get wiped out from everything. So much you need to look into within the 506B and C as an investor, and as a sponsor, you want to make sure this is clearly defined as well, because you want to make sure you have a path to understand if things go wrong, what is the path, and leave it up to you, not different investors, to come up with different paths. And as I mentioned, a 506B or 506C can be done $10,000 to $15,000. I'm recording this in 2025. And again, depends on the attorney and the experience, but that's typically, I think, where most of them fall. Now let's dive into the Regulation A, because I have a lot of people call me and say, I want to do a Reg A. Now, when you hear the term Reg A or Reg A plus, it's the same, they're interchangeable. It's technically a Reg A plus, but you can raise a lot of money. We've raised $40+ million. It's open to everybody. It levels the playing field. So we have investors who invest $5,000. We have investors who invest $500,000. If you've got set up a IRA with $6,000, you can invest that in an alternative like a Regulation A offering and not have to worry about the $50,000 or $100,000 minimums. But let's follow the paper trail and see what it really costs. So you have to draft an offering circular, which is a PPM on steroids. The legal fees to draft this can be anywhere from $25,000 to $75,000. Now, if you've done multiple, yes, it can be slightly less, but anticipate spending $25,000 to $75,000. Maybe you got a good attorney that can do it for less. That's what I would ballpark. Then you have to have annual audited financials. Now, if you just started your company and you're doing your first audit, I call it a snowflake audit because you put $100 in a bank account. For that, you don't need a powerhouse auditor. You could. For ours, we spent, I think, about $7,500 for that initial audit. Now, when people think of an audit, I just want to be clear, you think, oh, it's just the money. No, it's a lot more behind it, especially for an SEC audit. They want to know your process, your rules, who's approved. Is it one person who can pay the bills and move money around, or is it multiple? They want to know that you have documentation if you have employees, that their salaries are in writing. There is a ton of things within these audited financials that you need to prove, not just where the money goes. It's all about the operations of the company. Now, once you're up and running, you're going to spend anywhere from $30,000 to $75,000 a year on audits. Now, that legal fees, that's just a startup. We'll get into continuing costs, but you'll have your audits as well. So let me just talk about continuing costs on legal. Every year, you have to submit in a Regulation A plus offering a semi-annual report, which is unaudited financials with updates to the company. Expect that to cost $5,000 to $10,000, depending whether you do it in-house or still have to have attorney reviews. You have to, after your audited financials, you have to submit what's called a 1K form, which I included that 30 to 75. That's part of that cost. And then every year you have to resubmit your offering circular. You have to refresh it every year to keep going. And that is going to be another $5,000 to $10,000 in costs. Now for us, our first year, we submitted, got renewed, these, okay, you're requalified. Second year, they came back with about 10 pages of comments. And it was the same exact offering, but it was just a different reviewer. And we had to spend that second year probably an extra $10,000. So it's very unpredictable on what those costs could be. Promoter and marketing fees. Now, we work with a broker-dealer for blue law compliance about raising money in all these states, which they take anywhere from 0.5 point to 1% of the money raised. So think about that. And if you are marketing and you are a new sponsor, you've never raised money before, expect your marketing fees to be about 10%. If you could get it for 5 or less, be thankful. But it's going to be expensive. So it's going to cost you $1 million to raise $10 million. And I know you're going to say that's not feasible or viable. Well, if you look at it over a span of, if your offering's 5 years, it's about 2% per year amortized over that time. You should have 2% within your numbers. But I see people doing a 12-month offering or shorter term offerings. I don't know how they make money, but that is the one area, the marketing fees, where people underestimate. And let's say you go institutional route and you have working with an RIA, a wholesaler, broker dealers, their fees are going to range from 5 to 10%. When I see people talking about, oh, it's going to cost me 1 to 2% to raise money, 99% of the people will never be able to hit that number. Now, for your first million or 2 million, yeah, you might have friends or family and people who can contribute. But if you're looking to raise 25, 30, 50 million dollars, you are going to spend a considerable amount in marketing fees, commissions, and other costs. Now, other costs that you may incur, we have the broker dealer. We have an escrow agent, so the money doesn't come right into our bank account. We also have a transfer agent who holds a capital stack. So an investor can call up and say how many shares and stuff they have. So if I disappeared off the face of the earth, which some sponsors have, it's a third-party company that says, hey, you still have this. So just to launch, to add up the legal, audited financials, marketing fees, everything else, it's going to cost you over $1 million. Now, take away the marketing fees and just the legal, auditing, and just getting qualified, I would anticipate spending $100,000 to $150,000 before you're allowed to raise money. So I want to say that again. It's going to cost you $100,000 to $150,000 before you can raise money. So if you don't have that money already, you're not going to be able to get qualified because your attorneys and everybody else are going to need to get paid. The cheapest I think I've seen somebody do it has probably been for about $40,000 to $50,000, but that was bare bones. But if you're thinking you can try and get something done for $10,000 or $20,000, it's not going to happen. So Regulation A is powerful, but it's not a beginner's game. Designed for sponsors who have some money, an established brand, and bigger goals, and like I said, deep pockets. With all that being said, we wrap up this episode. Who should use what? So here's my advice and where I think which type of offering you should use. So if you're raising money from your own network, doctors, lawyers, high net worth friends, and people, go with a 506B. Low cost, private, flexible. You can't advertise, but you already have a network of people. So that's what I would recommend, especially if you're going to raise up to $5 million. Go with that network, go with a 506B. That's probably, your best bet. If you have some type of brand, some type of influence, podcast, big email list, social media following, use a 506C. You can advertise, but it's only for accredited investors. So just because you might be a good marketer, you still got to have a really good business plan and get these people through your marketing funnel to want to invest in your offering. Because a lot of times these are not your own network. These are people that you have to do outbound marketing with. If you're looking to raise 30 million or more and have that brand and are offering something a little bit different, a Reg A may be worth the cost and effort. It just really depends between the 506C and the Regulation A+. Now, it really depends on, if you're doing a large multifamily deal, I would do a 506C. If you're doing an evergreen fund, like we have, I'd consider it a Regulation A because it's open and you can allow investors to continue to come in and leave. So that's where the Regulation A fits in. Also, depend on your offering. Debt funds, I actually prefer the Regulation A because when I try and compete against multifamily investors who are offering 20% returns, they may get it, they may not, but that's an equity play, an income play, like a debt fund that provides payments monthly or quarterly, but it's more consistent with little to no upside. You'll get Regulation A people or non-accredited people in that offering as well. Lastly, if you're launching really small deal and your startup under 3 or 5 million, try the Reg CF. Personally, again, I'm not a fan of the Reg CF. I know people who have done it, but not many for real estate. And again, if you have some app or technology, Reg CF is awesome. So I'm not discouraging Reg CF. For real estate is where I'm wondering if it is actually the right fit. So just remember, there's no one size fits all when it comes to raising capital. There's only the right tool for your specific audience and goals. And I want to just beat that a little bit into the ground, because just because I am doing a Regulation A doesn't mean you should be doing a Regulation A. And just because they're doing a 506B doesn't mean you should or I should do a 506B. You need to map out what fits your plan and what is best for you, and what are you going to try and get to accomplish your goals. So at the end of the day, your capital raise should align with your business strategy, not for your business to fit the raise. Lastly, I'll leave you with this. Know the rules, pick your path, and follow it with clarity and confidence. And again, know the rules. I can tell you, I know 3 offerings right now that are competing against mine that are 506Cs that have never filed the exemptions with the SEC, and their documentation and paperwork looks like it was made with ChatGPT and not an attorney. And this goes back to what I mentioned earlier. Do it right. Whether you're the sponsor or an investor, use the right attorney. So thanks for listening to this episode or watching. If you want, in the comments, put cheat sheet, and I will send you an infographic and put it in the show notes to outline everything we talked about today with kind of a nice chart of where each type of raise fits in. And if you want help structuring your next raise, feel free to reach out. I'm always happy to share my experience and talk to you about not only what we think we did right, but some of the mistakes we made along the way. So thank you for listening to this episode of The Papertrail. Make sure to subscribe, leave a review, and share this episode with someone who is planning their next raise. Thanks for joining me on this episode of The Papertrail. I hope today's insights help you sharpen your note investing strategies. If you found value in this conversation, subscribe, leave a review, and share it with fellow investors. I'm Chris Seveny, reminding you to keep doing the work, trust the process, and always follow the paper trail. Until next time.